Hey everyone, and welcome to The Explainer. Today, we're going to pull back the curtain on a powerful and kind of sneaky force that might be silently hurting your stock portfolio. It's a hidden factor that, thanks to some awesome research from FinStill, every investor really needs to get a handle on. So let me ask you this. Have you ever been in this situation? You own a stock, the company is crushing it, sales are through the roof, products are flying off the shelves, but for some reason, the stock price is just flat. It's super frustrating, right? It feels like you're missing a piece of the puzzle. Well, a massive piece of that puzzle could be this one number, 120.7. Now, that's not just some random number. It's the current reading for the US dollar index. And as FinStill's research points out, that's sitting right near the top of its 5-year range. What that means is the dollar is incredibly strong right now compared to other currencies around the world. And that right there, that's our culprit. This historic strength of the US dollar is this powerful, often invisible force we're talking about. It creates a huge headwind for America's biggest global companies, the ones that make up a giant chunk of the S&P 500.
So how in the world does this actually work? How can a strong currency possibly be a bad thing for a company's profits? It sounds kind of backward, doesn't it? Well, let's break down the mechanics.
Okay, so the main idea here is something called the translation effect, and it's actually way simpler than it sounds. Just imagine a US company has an amazing quarter over in Europe. They rake in €1 billion. Awesome. But when they report their earnings back home, they have to translate that money into US dollars. And if the dollar has gotten stronger since they made that money, their €1 billion now buys fewer dollars. They did the exact same amount of business, but boom, just like that, their revenue shrinks on paper.
And this isn't just a vague idea. We can actually put some numbers on it. The FinStill research gives us this fantastic rule of thumb to remember. For every 10% jump in the dollar's value, the total earnings of the S&P 500 drop by about 3 to 4%. That really shows you how much this big picture economic force can hit the stock market where it hurts, right in the fundamentals.
Okay, so we get the how, but as an investor, you're probably asking the more important question. Okay, so who gets hit the hardest? Which corners of the market are most vulnerable to a strong dollar? Let's dig into the data. This data, which FinStill pulled together from SEC filings, makes it pretty clear that some sectors are way more exposed than others. You can see right here that technology is leading the pack, making almost 46% of its money outside the US. And right behind are materials and consumer staples. These guys are on the front lines, fighting against these currency headwinds. Now, this table gives us an even bigger picture. And you got to look at that consumer staples number, over 41%. That's a real shocker for a lot of investors. You might think of these companies as safe or purely domestic. But global giants like Procter & Gamble, they actually make more than half their money abroad. So the takeaway here is crucial. Even sectors you think of as defensive are definitely not immune. And when we drill down to specific companies, man, the exposure is just massive. Check this out. Monolithic Power, Booking Holdings, Applied Materials, they're all getting well over 90% of their sales from outside the US. And you can see a really clear theme here. The semiconductor equipment industry, with names like Applied Materials, Lam Research, and KLA Corp, is maybe the single most dollar-sensitive group in the entire market. To really see what a difference this makes, check out this comparison. It's perfect. On one side, you've got Applied Materials, with a staggering 94.3% of its revenue coming from overseas. On the other side, you've got a home improvement store like Lowe's, with just 0.1%. A strong dollar is a major, major threat to one company's earnings, and it's literally a rounding error for the other. This is exactly why you have to know where a company makes its money. So what about the big guns? The Magnificent Seven, the stocks everyone is watching. Well, even within this elite club, the currency risk is all over the map. Meta and Apple are the most exposed by a long shot, earning most of their cash abroad. And here's a really smart point from the FinStill analysis. While NVIDIA's official number here looks lower, their end market exposure, where their chips actually end up being used, is way more international than these filings suggest. But what if you're thinking, okay, how do I just avoid this whole headache? Is there a way to sidestep this risk completely? Absolutely. So let's flip the script and look at the companies that are pretty much insulated from all these currency swings. Here are some classic examples of what you're looking for. We already talked about Lowe's, but also think about companies like domestic pipeline operators, Kinder Morgan, or U.S. healthcare distributors like Cardinal Health, or even an airline like Southwest that pretty much only flies within the country. All the revenue is earned in US dollars, which means what the dollar does overseas, it just doesn't matter to their top line. They're naturally protected.
All right, we have covered a ton of ground: the what, the who, and the why. So let's wrap it all up with the most important part. What can you actually do with this information? Here's your investor playbook. So based on Finstill's analysis, here are 4 key strategies for when the dollar is strong. 1, think about tilting your portfolio a bit more toward those domestic-focused companies. 2, be extra careful with those highly exposed industries we talked about, like semiconductor equipment. 3, become an earnings call detective. When you hear a company mention constant currency growth, that's them telling you how the business is really doing without all the currency noise. And finally, number 4, remember that this stuff can be delayed. A lot of companies hedge, so today's strong dollar might not fully hit their earnings reports for another year or so. And I just have to say, all of this incredibly detailed analysis, from the sector data all the way down to the individual company numbers, it comes directly from the research team at Finstill. They just do a fantastic job of digging deep into the data to uncover these kinds of powerful, actionable insights.
Look, if you found this explainer helpful and you want to become a smarter, more informed investor, you should seriously give Finstill a follow. And even better, go check out their website. They have over 300 free learning concepts and a ton of powerful tools to help you analyze companies on a way deeper level. It's an amazing resource.
So, as we wrap up, I'll just leave you with this one simple but really powerful question to think about. Go take a fresh look at your own holdings, but this time, look at them through this new lens. Is your portfolio prepared for currency risk? Thanks for watching.